Good afternoon, everyone, and thank you for joining. We're going to let everyone continue to log on and get started in just a couple of minutes. All right, let's go ahead and get started. Hi, everyone. Thank you for joining today's webinar, Top State and Local Challenges for the Healthcare Industry. Today's program will be presented by Jim Bartek, Partner and SALT Practice Leader, and Jason Rosenberg, SALT Senior Manager. Before we begin, I have a few notes. Today's materials can be found in the toolbar on the right of your screen. Also, at the bottom of the toolbar, you will see a questions box. Feel free to send us your questions during the presentation. We will do our best to address them at the end. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there is a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. With that, I will turn it over to Jim.
Thanks, Rachel. Welcome to Withum's Healthcare Webinar Series. As Rachel mentioned, today we'll be talking about the top state and local tax challenges for the healthcare industry. With the current pandemic affecting state revenues and pressure for the states to provide more state services, states are taking a more aggressive position and increasing audit activity. Therefore, during the session, what we'll talk about is and cover some areas of risks and possible opportunities we see with our clients as states look to rebound from the pandemic. So as first introduction, I'm Jim Bartek, leader of the State and Local Tax Group at Withum. While I'm located in the Whippany office, I do spend significant time in New York City and Philadelphia, as well as many of our other offices. I have over 25 years experience in state and local tax, including 22 in the Big Four, helping clients deal with state and local tax issues, including sales and use tax, building tax process, nexus studies, gross receipts type taxes, voluntary disclosures, refund reviews, audit defense and appeal, as well as due diligence on both the buy side and the sell side. And I'm joined by Jason. Jason?
Yeah, thanks, Jim. So I'm a senior manager and team leader of Withum's SALT Income Franchise service line. Based in the New York office, I have over 12 years experience in multi-state income tax, which includes state tax planning, nexus analysis, revenue sourcing, audit defense, and credit and incentives. It's nice to have everybody here, and I know we have a lot that we want to cover today, so I'm going to turn it over to Jim to go over the agenda.
Sure, next slide. So during this section, we'll talk about the current climate of state and local tax, basically give a background on how the states are doing during the pandemic. Then we'll give some highlights regarding some areas where we see some common sales and use tax risks, such as exemption certificates and sales by healthcare companies. We'll also discuss some state and local sales, some sales and use tax audit issues. Then Jason will cover state and local tax pass-through entity taxes. or other workarounds is what they call them. And you may have heard that term. And then Jason will also talk about issues our clients have been dealing with related to telecommuting, which is a big issue now as people are hiring around the country. Then we'll discuss what we're seeing with telehealth in the SALT arena, and we'll wrap up with a brief summary of what you should do to deal with all these issues. Now, as Rachel mentioned, please send in questions and we'll answer during or after the session via email if we don't have time at the end of this session. Also, our contact information was listed before. It'll be listed at the end of the session as well. So feel free to email us anytime or just give us a call, and we're happy to answer any questions you might have. Next slide. So let's start with the current landscape of state and local tax. So it's important to understand again how the pandemic is affecting state and local revenue, so we can understand what may be enacted moving forward, as well as how states will enforce their taxes, such as audits. With that being said, which states do you think are best and worst rated for the business climate? And here you'll see the answers. And again, it hasn't changed much from last year. New Jersey at number 50 is not something I'd be proud of as a New Jersey native. We have high income taxes, high property taxes, sales taxes are average at around 6.625. But New Jersey does impose sales tax on a lot of services. New York is at number 48, which improved from 49 last year. Again, high income taxes, high sales taxes, tax a lot of sales tax on a lot of services, and very aggressive audit state with offices around the country. California at 49, again, high income taxes, high sales taxes, don't tax a lot of services, very aggressive. And what are the best? You have Wyoming at number 1, South Dakota at number 2. Both these states, no income taxes, but they do have quite a bit of sales taxes, as that's how they get their refund. Like South Dakota has taxes on basically everything. Florida, again, number 4, no personal income tax here. They do have a corporate income tax, but no personal income tax. In case you're wondering, Texas was number 13. They do have a high sales tax rate, and no personal income tax, very aggressive on audit. And Pennsylvania was around the middle of the pack. So what do you think is the largest source of tax revenue for the states? Next slide, please. So in 2019, I couldn't find a chart for 2020, but 2019 individual income tax heads this up at 41.5%. Now, states rely on the individual income tax. That's why we'll spend a good amount of time later on pass-through entities, which are, if you have partners and so forth, the pass-through entities are going to be, the income tax is going to be on the personal income tax return, as well as telecommuting, which affects how an organization has to collect or withhold tax from their employees. Now, consumption taxes like sales tax, gasoline, and so forth are around 17.5%. States like Florida, who don't have an individual income tax, certainly rely more on the sales tax. And you might note corporate income tax is only 3.9% of state revenues, but as I mentioned, pass-through entities are taxed at the individual level. Next slide, please. So this chart shows how high sales taxes are in the states. Sales tax have definitely struggled after the initial stay-at-home orders in March and April of last year of 2020. As you can see here, sales tax rates are pretty high across the country, so make the wrong decision as an organization on whether you should pay sales tax to a vendor or not charge it on sales. You could be on the hook for quite a large amount. And the Wayfair case, which we'll talk about in a bit, definitely helped during the pandemic, as how many of you have spent hours shopping online? I mean, we had packages delivered to our house every day, still do. Stores were closed, so we bought everything online. I even got to know the UPS driver. So certain states did not do so well with sales tax collections, such as states like Hawaii or Florida, for example, because they're tourist destinations, even New York City for that matter, as everything was closed. But Florida also didn't do well because they didn't have an economic nexus statute at the time. And again, we'll talk about Wayfair later. Next slide. Jason, you want to talk about groceries?
Yeah, so grocery receipts taxes are generally very cost prohibitive as they negatively affect businesses with low profit margins and high production volumes. So it does, gross receipts taxes don't take into consideration generally any expenses. So these kind of taxes are going to negatively impact break-even companies or lost businesses, right, as there still will be an entity level tax regardless if there's any profit or not. And we see, a handful of states that use these taxes, and in practice, very frequently they come up in a due diligence as a high exposure state just because of the nature of the way it does tax. Oregon's one of the more recent states to enact such a tax. What's unique about Oregon versus the other states that do use a gross receipts tax is that in addition to the current income tax in Oregon, right, they also added their own CAT tax, which they refer to as a CAT tax, which is a gross receipts tax, and it never repealed its Oregon income tax. So it really just simply complemented their current tax structure with an additional tax, where most other states like a Texas that we have on here, or an Ohio or Nevada, they don't have any income tax. They just have a gross receipts tax. So, we expect that this trend will continue, where some states are going to take a look and see how can they raise revenue by keeping their current income tax, but then also layering on a separate gross receipts tax as well.
Yeah, I think that's important, Jason, as we've discussed many times before, is this gross receipts tax, it could be the wave of the future, a little more predictable like a sales tax, whereas income tax revenue may be up and down depending on the economy. Sales tax revenue is pretty constant for the most part, except during the pandemic, of course. Next slide, please. So as you can see from this graph, this is the projected revenue for it's 27 states in July of 2020. So keep in mind this was right after the pandemic started. They did predict that income taxes would fall sharper than sales taxes. They didn't believe businesses could sustain the pandemic. Now, all states were expecting to face a tough road ahead with the COVID-19 unknown. And again, it was created prior to the recovery, this chart. So collections actually recovered better than the graph shows. As you see, total revenues were expected to be significantly lower in fiscal year 21 than fiscal year 20. Next slide, please. So overall, due to the pandemic, fiscal year 2020 state revenues were down quite a bit early, as much as 15%. And then they recovered in the last quarter to close only 5.5% down. And keep in mind, state budgets are usually through July of 2020. There's a few exceptions like New York. So some states were lower than others, like California was almost 10% down, New York 8%, Texas 7%, Alaska was 32%. New Jersey was flat, but they did borrow quite a bit of money, and PA was down about 5.5%. So individual income taxes dropped 10% year over year, again, fiscal year 2020, but timing had something to do with this because the sluggish economy. But timing, as a lot of the income tax collections were delayed last year. Now, keep in mind, this was after a very strong 2019 and beginning of 2020 through February. So March, April, May, and June were very slow due to the pandemic. And as we discussed, online sales picked up, so sales tax revenues were not down as much as expected. So that's why the overall collections were down slightly for 2020. That being said, down 5% was much better than the April estimate. Next slide, please. Now in New York, we'll go through New York because they did finish their fiscal year, and their fiscal year ended in March. Tax collections were $2.8 billion lower than the prior year. So needless to say, New York did project a gigantic loss over the next 4 years. At one point, believed to be $60 billion. A lot of that was based on revenue that was in September. They had year-over-year comparisons where they were quite a bit down. They were down about 17%. So it did recover quite a bit over the last period. So again, the New York total tax collections for the fiscal year over year is actually pretty flat. It's about $500 million lower than fiscal year 20. and $3 billion higher than projected, which is your middle number there, the 79.3, which was projected after the pandemic hit. Now, as you can see here, while sales tax is clearly down to the closures, income tax collections were up. They were $55 billion, which was a $1.3 billion increase, and projections exceeded $2 billion, exceeded by $2 billion. However, sales tax and other consumption taxes were still down almost $2 billion, or 10% from the prior year. Now, also, one other note is the first 2 months, April and May, income tax collections were up $4 billion in New York, so $16.5 billion collection. And sales tax revenue was at about $2.9 billion, so up 47% than the same period prior year. Again, there were full lockdowns in the previous years. So it'd be interesting to see how many, how New York budgets do and how many people stay in New York with the high tax rates and so forth, and with the new rules by companies where basically work in a lot of different locations. Okay, next slide, please. Georgia, we'll just go briefly. We just selected 2 states, and again, revenue is pretty flat. Again, that's good news. Again, at the beginning of the year, everybody thought that it was going to be quite a bit of a downturn. So again, overall revenue is not as bad as we thought, as it would be at the beginning of the pandemic and even halfway through. I do expect that we'll see overall state and local revenue increase if the economy stays strong and restrictions are relaxed. Next slide.
Yeah.
Jason.
Yeah, so there's been unprecedented changes in state and local tax the past several years, but clearly 2020 was a year like no other, and we expect to feel the aftershocks of COVID-19 within state and local tax for years to come. What we're seeing, right, is state and local governments are being forced to address revenue shortfalls while also balancing the importance, to attract much needed business to the states. We've continued to see states step up their economic nexus enforcement, taxing businesses by simply having a virtual presence in a state, with states continuing to broaden the tax base. And we're also in the middle of a wave of change as states rapidly enact entity-level taxes on pass-through entities. And so when we look at some of the developments and trends that we're seeing, not just in the past 12 months, but what we expect to, on a going forward basis, a continuation of what we expect to see, is number one, with the broadening of a nexus standards, right? That takes center stage with some of these changes that we're seeing, with widespread assertion of economic nexus, which essentially allows states to tax businesses with simply having a virtual presence in a state. And with the Wayfair case decided a couple of years back for sales tax purposes, this has enabled states for all tax types, including income tax, to impose tax on businesses by simply having customers in a state, regardless if the business doesn't have any physical presence in the state. So with most service businesses providing services across state lines, in addition to what we'll talk about in a little bit on telemedicine, simply sending, billing a customer or a patient for that matter, or, an end consumer to a product or service that's across state lines, maybe they're sitting in California or elsewhere, right? That could simply result in a filing obligation. Now, with rate increases, as states continue to emerge out of the pandemic, we're seeing traditional rate increases across the nation. And just in our own backyard here in New Jersey, we saw the top rate increased at a lower threshold. And we also saw the corporation surtax, which was supposed to sunset after 2021, now has been extended through the end of 2023. And in New York, we just saw legislation enacted a couple months ago that increases the corporate rate from 6.5% to 7.25%. And also for individuals, the bill brings tax hikes as well, adding 2 new brackets with a top rate of 10.9%. So for those individuals or lucky individuals that live in New York and also New York City, right, we're looking at a combined tax rate of almost 15%, and that far surpasses California or any other state. And so, what we're seeing is a lot of migration down to, states like Florida, Nevada, Washington, right? States without income tax, as we continue to see hikes. So this is a trend that we're seeing across our client base. And, it's not just New York or New Jersey, we're seeing rate hikes across the nation. And so, often using the pandemic as justification for these increases. We're also seeing the expansion of the tax base. Another way states increase taxes without any direct hikes to tax rates is just to broaden the tax base, which of course means subjecting more income to taxation. And we're seeing this through either measures of worldwide taxation, group reporting, or just simply the elimination of various state tax deductions. And then also what we're seeing is with the credits and NOLs, we've seen a lot of states limit the ability to utilize these attributes as another revenue raiser. So they're putting haircuts on the ability for utilizing them. And another trend that we're seeing is combined reporting. This has been a development for a number of years, really a significant trend for the past decade, and we continue to see a lot of activity with it across the 50 states. And this is simply where we have related entities that are part of one unitary business are required to file a single tax return, and it targets businesses that attempt to shift profits to low tax jurisdictions. But it could also negatively impact businesses which do negligible business in a state, but now are suddenly faced with a larger tax bill as the tax base of other affiliated entities are now pulled into the state. So this is something that New Jersey enacted effective 2019, and is something that we'll continue to see more states pass across the nation. And then lastly here, with exporting the tax burden, right, this is probably one of the most significant trends that we've seen, which is essentially states are shifting tax from in-state businesses to out-of-state businesses. And we'll talk about what that exactly means a little bit later on in the presentation. We could go to the next slide.
Yeah, thanks, Jason. We did get a question online about employees working remotely. We'll be covering that later in the session under telecommuting, so Jason will talk about that after. So again, some other tax trends we're seeing is depending on how the states are doing financially or how many additional programs they want to add, we could see some other tax trends. So here's a couple new trends potentially as well. So first is sales tax expansion. Many states still have some room to go on taxing services to businesses or individuals for that matter. For example, software as a service is not taxable in over 20 states, so that is a place where they could go. Digital goods and services is another area. We've seen some movement on that. During COVID, we saw companies move to providing services online. And I have a few clients that provide educational or CPE type services. As a matter of fact, one is a not-for-profit. And they had, again, we're delivering these services across state lines and therefore had to address it. Advertising, many states have bills in state Congress impose tax on digital advertising revenues, like Maryland recently did. Gross receipts tax, we talked about that. Excise taxes on gas, nicotine, cannabis, the hidden taxes like that. CEO pay taxes at San Francisco passed, and others are looking at this as well. And unclaimed property, which we'll talk about briefly in a little bit. Next slide. So sales and use tax, let's touch on sales and use tax. Again, the three areas we want to touch on sales and use tax are exemptions for healthcare, not-for-profit entities, sales by healthcare not-for-profit entities, and then state audits. So let's go to the next slide.
We're on to our first polling question. Have you renewed your Pennsylvania exemption certificates in the past 5 years? All right, about 10 more seconds. All right, I'm going to close it out. And here are the results.
Okay, so a number of you said yes here. So that's good, 30%, and I'll explain why that's important. Some may have said no because you're not in Pennsylvania, but if you haven't, again, I'll explain that as well. And then the third answer, why do I have to renew the certificate? I'll tell you that in a second as well. And then I have no idea, which is a lot of the answer I would expect, because a lot of companies don't really pay attention to this. So if you want to move to the next slide. So if you work for a nonprofit, you may take sales and use tax for granted. That being said, you should pay attention to sales and use tax. We do find a lot of errors with certificates with many healthcare organizations and not-for-profit entities because the certificates might not be reviewed. Now, the first bullet here says each entity must apply for an exemption. That's important because what happens is if for sales tax purposes, each legal entity that has its own ID number is treated separately. So you can't use one certificate for an exempt entity for another, okay? It's very important. A lot of people don't understand that, especially as they reorganize. So we work for many organizations where there could be mixed use as well. So you could have some entities that have for-profit entities as well as not-for-profit entities. For example, you might have a management company. This management company might not be deemed used for as a not-for-profit because sales tax is generally going to be waived for a charitable mission of the not-for-profit entity. And would the management company have a charitable mission? So sometimes that has been challenged by certain states, just something to keep an eye on. So what I always tell clients is you should definitely need to think through the downstream tax issues when organizing the company. Again, each separate legal entity should be considered. In addition, not all states grant exemption certificates for the life of the certificate. This is why we asked that question about Pennsylvania. Certificates expire after 5 years in Pennsylvania. Florida is the same, and there are certain other states where the certificates will expire. So if you don't renew the certificate, it's not a valid certificate. Now, keep in mind, especially in the last year, some states may have mailed the application for renewal. And with COVID, if you weren't in the office, we've had clients that didn't receive notices, no matter what they might be. So again, just keep that in mind. I would suggest to everybody, take a look at your certificates, see if they're valid, see if you have one for every entity. Check this annually. And obviously, if you have any questions for us, just shoot them to the question board where we can, and we'll address them at the end, or you can give us a call. Again, could be a liability if you're not compliant. And we've had many audits where we've defended where the certificates expired in certain locations. We also had in New Jersey where we had a for-profit entity using the exemption certificate for the not-for-profit entity. One way this happens a lot of times is if you do have some sort of shared service entity and that company is purchasing items and then allocating them across the entire organization, which could include both for-profit and not-for-profit entities. Okay, so one example would be software, where you'd see that. Even something as simple as Microsoft Excel. With that being said, savings could also exist. Like, for example, you may not issue a certificate and you're being charged sales tax. Again, it's not one of the things you're focusing on if you're not for-profit entity. And you're not reviewing the invoices for sales tax paid. So we have found significant refunds for companies in the same manner. Next slide, please. So sales by healthcare entities. If you have Nexus for sales tax purposes, you will need to register and collect taxes on taxable purchases, products and services. It doesn't matter if you are not for profit. You will have to, in most states, you will have to collect tax on taxable services or products you're selling. Now, what does Nexus mean? Again, Jason touched on it a little bit, but physical Nexus is if you have people in the state, you have property in the state, inventory, or you send salespeople into the state, that would be physical Nexus. Economic Nexus is, again, Jason mentioned the Wayfair case. That basically said that if you have a certain amount of sales in a state or a number of transactions in a state, you pass those thresholds, whether you have physical Nexus or not, will have the obligation to collect sales tax. So that is true for not-for-profit organizations as well, and of course, for-profit organizations. So again, the exemption is based on the end user only in most states, not the seller. Okay, there are some exceptions to that, but that's the general rule. Also, keep in mind that there could be tax due on sales of tangible personal property, like it's cosmetic or dermatology products or so forth. If you have a dermatology practice, again, you could, when we handle audits, they're usually looking into that. We handle audits for large physician groups. Cosmetic surgery is one. Certain states have a tax on that. And then, of course, your usual bookstores, or if you're selling software. Again, if you're not-for-profit or government, there could be exemptions if you're selling to them, or if someone's buying something for resale. But we're working with several not-for-profit companies selling into other states. One, for example, is selling tangible personal property, which such as shirts, water bottles, stuff like that. And they pass the thresholds because they have so many members. We're also working with another who developed a software program internally and winds up selling to other entities similar. Therefore, they have to follow the sales and use tax rules. And another not-for-profit I mentioned previously was selling an online course library and training classes and so forth. So again, which could trip up some sales and use tax rules. So, but generally, as a general rule, sales of tangible personal property is taxable, and certain enumerated services are subject to tax unless an exemption exists. Okay. Next slide. Now let's touch on some audit activity. Go through this quickly because we want to get to the next sections. But definitely a rise in audit activity by states like New Jersey are still underwater with funding certain obligations, so continue to be aggressive. Audits can be triggered by certificates used incorrectly. Sometimes they find the incorrectly used certificate by auditing your vendor and looking at their certificates they received because they're not charging you tax. Sometimes they audit one company of yours and now understand there are other entities included in the organization and start asking questions about that. So what are some of the common audit issues? Items purchased tax-free for use by the for-profit entities, we mentioned that. Management fees, what does this include on a management fee for a shared service center, for example? Might offer IT or maintenance, which could be taxable unless there's an exemption. Intracompany sales as well. If you're selling between entities, sometimes you're still going to need to follow the sales tax rules. And of course, payroll withholding, which we'll talk about after. So it's important to set up a use tax process. We didn't talk a lot about use tax, but use tax is complementary to sales tax. If you're not charged sales tax, you need to have a process to identify which items should have been charged sales tax or should accrue use tax and remit it to the state on the for-profit purchases. Next slide. Here again, technology. We see this a lot with purchase by shared service center and used by all entities. I mentioned that before, both for-profit and not-for-profit, or it could be developed in one entity and used in another. And again, use tax process is important here. If no tax paid, then it should be accrued and remitted to the state. Also for refunds, again, if tax was paid, maybe it shouldn't be paid on some of the usage. So it's important to understand what was purchased. Was it software, information service, data processing equipment, and is it taxable? And then in that state or jurisdiction, and where used. So each state has its own rules. So you have to understand what are the rules in those jurisdictions and which entity is using. And we'll touch on telehealth later with the potential software usages there. Next slide, please.
Okay, we're on to our second polling question. Has your organization been audited? All right, about 10 more seconds. All right, we're going to close the poll, and here are the results.
Okay, so yes, we're handling an audit right now. Had a good percentage. 12%. Audited in the past, 32%. Hopefully there weren't many assessments, and some say never or no idea. Again, hopefully, we do expect that states will be auditing in the future, and they do know that they, again, they will check on you if nothing else to make sure you're doing things properly. Okay, so we're going to go through unclaimed property real quick because again, we want to get to telecommuting and the pass-through entity taxes. So in addition to for-profit companies, we've had several not-for-profit clients receive unclaimed property notices recently. Just because you're a not-for-profit doesn't mean you're not subject to unclaimed property. Any property held, owed, or unclaimed by the owner of that property after a dormancy period is presumed abandoned. Okay, that dormancy period is usually 3 to 5 years, depends on the state. And that property should be remitted to the state of the last known address, if known. If not, it's your state of incorporation. So some examples of unclaimed property: outstanding checks, payroll or AP are good examples. Accounts receivable credits or refunds, such as you get insurance reimbursement after patient payment or tuition reimbursement, for example. Those are good examples of potential exposures where it should be remitted over to the state. Stock, gift cards, and so forth. Again, states are sending notices on unclaimed property. Watch out for it if you get it. Make sure you call your service provider, and we'll tend to help you out. Next slide, please. Jason will talk about state and local tax pass-through entity taxes.
Great. Yeah, we can flip over to the next slide. Okay, perfect. So one of the centerpiece provisions of the TCJA, or otherwise known as the Tax Cuts and Jobs Act, which was passed into law December 2017, was the limitation imposed on the deductibility of SALT. The TCJA imposed a $10,000 limitation on the amount of SALT that individuals or pass-through business owners may deduct for federal income tax. So this SALT limitation profoundly impacted many businesses. And as the majority of small businesses predominantly use pass-through entities, right, in order to structure their affairs, while businesses were awarded tax cuts, in many cases, these cuts were nullified by the inability to continue to deduct SALT, especially in the Northeast, where there's significant state and local tax. Some states responded by enacting various workaround bills in an effort to mitigate the impact of this limitation. And the premise of a pass-through entity tax, which is what we're seeing across many states now, is for a business to elect to pay at the entity level instead of flowing that income to the owners, which the business then would, at the business level, right, would not be limited in the amount of SALT deduction it can take, where that at the individual level, when it flows through, it would be limited. So if we look at the next slide here, for years, only a handful of states had imposed entity-level taxes on pass-through entities. However, in recent years, there's been a significant development, as I've mentioned, with states enacting PTE income taxes. I would say about, as of today, and it's been a really fast-moving target, there's probably about 15 states or so that to date that have enacted elected PTE income taxes. And then there's a number of proposals that are sitting out there which continue this trend. There's an expectation that this trend is going to continue to gain steam in light of the IRS's issuance of Notice 2020-75, which was guidance that the IRS put out last November affirming the use of PTEs, pass-through entities, taxes, which essentially is the workaround from the personal individual level. So we can see in the next slide here, right, with the map, you can see as of April 2021, with states that have now enacted PTE taxes, and also you can see states that have proposals, and a number of these states have already, since April, have added and enacted PTE taxes. New York just last month enacted a PTE tax. Georgia just came and enacted a PTE tax, and there's been other states that have now turned green. And then in addition, there's many other proposals that are sitting out there that we expect that legislation will be passed. So as long as the SALT deduction will continue to be limited at the federal level, there's going to be a large number of states that are likely going to pass these elective PTE taxes. And with these PTE taxes, it's really important that we think about, does it make sense for the business to elect? How does it impact the overall business, and how does it impact each partner or shareholder of an S Corp that is making this election? Because there can be potentially, when you model this out, where certain partners benefit and other partners, it's an adverse benefit. There's no benefit. It's a negative impact. And so it is important that these things are modeled out, especially when it's elective, to make the determination if it makes sense to go through with a pass-through entity tax. We can see on the next slide here. Yeah, perfect. So we can see here that, right, by passing through a net amount of income tax reduced by a SALT deduction, the owner is able to fully deduct their state taxes for federal purposes. Additionally, the owner would not be double taxed in the state, as a credit to offset the entity tax is generally passed through to the owner. In states where PTE only calculates tax on state-connected income, businesses that are most likely to benefit from this election would be businesses with significant state presence. So what we mean by that is, right, for example, New Jersey has the BATE, which is their name for the PTE tax. And New Jersey, in order to benefit from the BATE, you have to have sourced income to New Jersey based on how New Jersey sources income. And what we'll see, for example, in New York, right, for a partnership, if you have resident partners of New York, all of their income is going to benefit from making a PTE election, regardless of how much is sourced to the state. So there's a lot of variation in how the states have imposed these PTE taxes. And again, it's really important that these things are modeled, because every client, every business has their own facts and circumstances. And, you can have, certain examples, depending on the facts, adverse, impacts. And in many cases, it's usually a favorable thing to make the election, but it is super important to model these things out. And we can see the next slide here. So there's a number of potential risks with making a PTE election, okay? And what we need to be thinking about, right, it really, as I mentioned, it really comes down to the facts and circumstances, but we're adamantly advising, right, modeling is done to minimize any unintended consequences. With that being said, there's one common denominator across the states with PTE tax, and that's the potential loss of non-resident owner resident credits. So as the tax is incurred and paid at the entity level in the resident state of a non-resident owner, right, there may be a loss of a resident credit. So for instance, if one elected a PTE tax in New Jersey, right, which is the BATE, and there's 5 partners in the pass-through entity, but 2 of the owners are residents of New York, if the PTE election was not made, the 2 partners in New York would have received a resident credit to offset their double taxation in New Jersey. However, with the PTE election, the question is, would the residents of New York be able to use the entity level tax now for a resident credit in their home state of New York? So it's super important that that analysis is done to minimize the risk of, of loss of a resident credit, as that could potentially nullify any PTE benefits. So again, there's a lot of great benefits out of making an election, and usually when we do the modeling, more times than not, it makes sense to do it. But there's also many examples where sometimes you got to make sure you understand what some of the pitfalls are. And there could be some, multi-tier structuring planning that can help mitigate some of these issues. So again, planning is super important when it comes to these elections. So with that, what we're going to do, if we go to the next slide, we're going to turn our attention to telecommuting and what we're seeing in light of COVID-19, and also as we pull out of the pandemic, and what we expect, on a going forward basis, is that we're going to see a lot of businesses, regardless of industry, have a telecommuting kind of footprint. So with that, if we look at the next slide here, right? So let's, what we want to do here, remote work is, here to stay. The question is, what is it going to look like? Right? Will it be a hybrid where we're in the office 2 days a week? at home 3 days a week or twice a month, right? Or what is it going to look like, right? And I'm sure it's going to be a mix. And we can see based on this survey, 83% of employers and 71% of employees have found remote work to be successful. And we expect employees to be demanding for these flexible work arrangements. And we are hearing in our discussions with clients, right, and with employers, they're seeing the value in remote work, which in many cases includes increased productivity, reduced overhead. It's a win-win. So from a SALT perspective with remote work, there are many implications we need to be considering. And when we think about the different impacts, right, number one, we're going to think about income tax nexus, right, or sales tax nexus for that matter, right? By having employees work in new states, that could trigger new filing requirements. We need to be thinking about income tax apportionment, right? As we discussed earlier, with each state sources the sales factor revenues, right, differently. States that rely, let's say, on cost of performance type of sourcing, right, which looks to the location of where the business performs the service, may see an impact to their apportionment formula as a result of remote telecommuting employees. We also need to be thinking about state payroll withholding, right? With employees working in other states, this will generally open up new state payroll requirements. However, many of our clients don't realize, but there are some states, such as New York, which apply a convenience of employer rule, which even though the employee might be working, let's say, in Maine or wherever, right, the employee assigned to a New York office may result in a double withholding obligation, where that they may be required to withhold in New York because that's where the employee is assigned to, and New York would require withholding regardless where that employee is working from. And then in addition to that, in Maine, because they're working and performing services at home in Maine. So states that apply convenience of employer rule, it's super important to consider all the different issues that come with state payroll withholding. Now, if we look at the next slide here, we can see as employees are getting acclimated to telecommuting, they feel more productive, okay? And this will continue to be the trend as better technology is deployed to employees and continued investment is made in the remote work environment. And also what we're seeing, if we look at the next slide here, and this is just showing that the pattern of remote work is here to stay. It's obviously not just a COVID thing. There was always the acceleration of remote work pre-COVID. This just really, put it at another level. And we expect it to stick around, stay at this level to some degree. And, that's what we're seeing with a lot of these surveys. And here we can see, right, over half the employees want to work remotely 3 days a week or more. So we suspect, as part of recruiting efforts and HR benefits, this is an area that companies are going to use to attract the best talent pool. And we can see in the next slide here, right? So again, we can see companies believe that employees' performance is improving on a number of different activities with remote work. And given the overnight disruption that resulted in remote work, it's likely that, with employers' continued investment, these positive performance data points will only continue to trend upwards. So with that, if we go to the next slide, let's do our polling question, I believe. Yep.
Yep, so we're on to our third polling question. Have you considered the nexus implications for telecommuting? About 10 more seconds. All right, we're going to close it out. And here are the results.
Okay. Yeah, so it looks like about 60% said yes and 40%, I would say maybe not. And again, it's super important. Let's continue. We're gonna keep looking at this right now. But and so when we think about telecommuting, right? First, nexus, right? In respect to telecommuting, it's relatively straightforward. Where you have presence of employees in a state, it's going to result in nexus unless the state provides a specific COVID-19 relief for that presence of temporary work as a result of the pandemic. While some states are providing relief, many states have remained silent throughout the pandemic, and they will not be providing relief. Second, with telecommuting, it's going to impact tax apportionment. Right? Apportionment is essentially a state's formula that's used in dividing up or allocating taxable income amongst the many states. and it's what's used to compute income in a state based on business activity within a state. And in some states, the consequence of an employee working from a different state as a result of the pandemic can affect the sales sourcing and the payroll factor of an apportionment formula. So we're seeing quite a bit of impact with the apportionment formula. And then also what we're seeing is impact with state payroll withholding. And traditionally speaking, right, most states source employee wages to the state where the employee performs the services. And again, that's unless there's temporary COVID-19 relief, which is quite limited in the number of states that are providing that relief. And especially with everybody going back to the offices, a lot of that relief for the states that have extended it are being lifted. So, you know,
Yeah,
in
Jason,
contrast,
that's one point. That was one point I was going to mention because there was a question on that is, you know, obviously there was some relief by a lot of states during 2020, but that may have expired. So it's important to keep up to date on those laws and so forth.
yes, agreed. And you know, when we think about payroll tax withholding, right, because we got the traditional rules, but what really throws the wrench into everything is the states that employ this convenience of employer rule, where these states are essentially requiring non-resident wages to be sourced to the office of the state where the employee is assigned to, opposed to where the employee is performing employment services. And again, that could result in double withholding requirements for the employer. So employers need to be actively developing policies that are aligned to managing those kind of risks. So those are the three core issues that we're seeing with telecommuting. Now, if we look at the next slide with state withholding, right? As we talked about some of the traditional withholding rules, now the effect of having employees working remotely on a temporary permanent basis can subject an employer to payroll withholding. And locations are going to really complicate the withholding requirements. And states that tax where an employee's assigned office is located or something along those lines can result in two states asserting the taxation of the same income. And so this is the issue, right? And we're seeing states sue each other, such as New Hampshire suing Massachusetts because Massachusetts is applying a convenience of employer rule, even though it's not a statute. They administratively are asserting it during the pandemic. And so we're seeing New Hampshire suing Massachusetts, petitioned it to the Supreme Court. We'll see if the Supreme Court ultimately takes it up. But these are a lot of the issues that we're seeing across the state lines right now. Now, if we look at the next slide here, right? And when we think about the convenience of employer rule, we need to think about a few different things, right? Many businesses are asking if they could simply reassign the employees to another office or just treat that employee's home office as the assigned office in order to sidestep the convenience rule. But it's not so easy because the assigned office in many cases is just going to simply be the location where the employee reports to. And it's going to consider a number of different factors. So it's not necessarily where the employee is assigned to on paper, but it's also, right, a number of different subjective factors that the state would look at, such as where does this employee send their work product to, right? Or what's the location of the employee's direct reports, or the location of where their annual performance reviews take place. So, New York issued guidance, late last year suggesting that even in the middle of the pandemic, the convenience of employer rules will apply unless the telecommuting location is established as a bona fide employer office. And meeting the bona fide employer office exception usually requires satisfying a host of different factors. And usually when we go through those different set of factors with our clients, many of them or most of them don't meet enough of them to have a bona fide employer office exception rule apply. So again, there's a handful of states, and especially during the pandemic, that are asserting the convenience of employer rule. And so especially during the pandemic, so it's something to be mindful of. Now, as we look at the next slide here, right, a number of states have issued a lot of different guidance and interpret how states would apply during the pandemic. And I'm not going to go through all of them just because we got so much limited time here, but you'll see that the states are all over the place. I mean, that's the bottom line. The states are all over the place and providing guidance. There's 50 different states with 50 different rules. So I'm not going to read through them right now, but again, the key takeaway is that it depends on the tax type, it depends on the issues, it depends on the facts and circumstances, but there's a lot of guidance that's out there. Now, if we get to the next slide here, and we could jump right into telehealth. Let's go to the next slide. Oh, we got a polling question first. Let's do the polling question.
Okay, we have our fourth and final polling question. Have you hired telehealth providers in new states during the past year? All right, 10 more seconds. All right, I'm going to close it out. And here are the results quickly.
All right, so it looks like a good split between yes and no. And so that's what we're seeing is a lot of telehealth, telemedicine. And again, we expect because of the convenience, because of a lot of the positive attributes, we're going to continue to see an increase. And you can see in this slide here, right, clearly from May to the middle of the pandemic, we're seeing a rise of telehealth and telemedicine. So with that, I think, Jim, what are your thoughts, from a sales tax perspective that we need to be thinking about when it comes to telemedicine?
Yeah, exactly. And I'll keep this brief, but basically telehealth, the way that one of the things you have to be careful from a sales and use tax perspective is on the purchase side. Of course, you're going to be purchasing technologies, and are those technologies subject to tax? Again, if you're a for-profit entity, some of those technologies could be taxable. Where are they taxable? What are you buying? And where are they being used, and so forth. On the other hand, also is that you could have some states, you got to keep an eye on digital services and whether a state would deem this to be a bundled service where you're having a portion of what you're selling as being potentially taxable. Obviously, if it's telehealth services, your medical services may not be taxable, but there could be some software components to it, such as some information services you're providing the client, your patients, and so forth. So again, are you selling software to your patient? Is it bundled? Is there a way? What is the true object of it, and so forth? What is the value of it? And as these services increase, you're going to get more value. So you just got to be aware of that. Okay, Jason.
Yeah, and just to add to that, right, from an income tax standpoint, when clinical care was provided in person, right, that was easy to identify. In most states, when it comes to in-person services, the situs of those receipts are going to be the location of patient services. Now we have a medical provider in one state providing a service across state lines with a patient in another state, and maybe an insurance company in a third state. And so the question becomes, right, how do you source these revenues? And that's where the issue comes on the income side is, now you have a sourcing issue that might not have been so difficult in the more traditional world, and now is becoming more complex. And unfortunately, right, not all the states have the same sourcing rule, and so you're going to have a lot of conflicting answers where multiple states might be taxing the same receipt, or none of the states are taxing any of the receipts. So it's really important to think about what the sourcing impact is from an income tax standpoint when it comes to telemedicine. Now, if we flip to the next slide here, real quickly. So you can see here that, traditionally you'd have three factors in calculating income tax apportionment, and that's the payroll, sales, and property factor. States have now been trending to just use the sales factor, making sourcing sales even that much more important when we think about telemedicine. If we look at the next slide here, one of the other trends that we're seeing here is states adopt market-based sourcing, which looks to where your customer is, or patient, right, the end consumer. And so you can see back in 2000, only a few states had market-based sourcing type rules. And if we flip to the next slide, you can see that map is quite filled in quite a bit. And we have more than half that now have market-based sourcing rules. And that makes the complexity of sourcing even more important to understand and consider, when we're thinking about telemedicine or telehealth. So if we look at the next slide here, Jim, do you want to talk about next steps?
Sure. Yeah, let's get practical. What do I do next? Next slide, and then we'll wrap up. So basically, what we say is, after all we talked about to help manage your risks, one of the things we suggest is perform a sales and use tax process review of exemption certificates for the completeness and validity. Your purchasing procedures, make sure you're paying tax on purchases for for-profit entities, and not paying sales tax on purchases for not-for-profit entities. It could be risks or opportunities there. Sales tax collection procedures. Make sure you're properly charging sales tax to customers where appropriate. Make sure your internal allocations of technology and mixed-use assets are accounted for properly, and that you have a use tax accrual process to account for them. Review your unclaimed property policies and exposures and consider a voluntary disclosure agreement if possible. Consider your SALT workaround planning opportunities, and analyze the effect of telecommuting employees, as again, could be nexus issues or withholding issues that could be liabilities for a company. And then review your sales and use and income tax implications for telehealth or other services. So with that being said, next slide. Again, we thank you for coming on board and joining us for this session, and look forward to talking to you in the future. If you have any further questions, if we didn't cover a topic, feel free to give us a call. Our contact information is there, or shoot an email.
Take care, everyone.
Take care.